The days of cheap financing in the U.S. are bringing about an accumulation of sovereign debt. The government faces roughly $18 trillion of it. How much more debt-driven spending can the country really afford? Market analyst Charles Biderman joins me with his thoughts. Now, first, Charles, let's look at public debt as a percentage of GDP. In Q1 in 2008, it was about 64% and has since risen to 103% in the same period this year. The past 45 years, Charles, that's a staggering rate increase to say the least. So do you think that the U.S. cannot afford to wake up to the potential crisis that lays before it?
The surge in government debt is not really the issue. It's the tip of the iceberg. The Medicare trustees report each year, in footnotes only, the present value of future U.S. liabilities for Medicare, Social Security, government pensions is over $70 trillion. That's the present value. And any public, that's the obligations the U.S. has, what you would have to put aside today to meet those obligations if you were a public company.
So, Charles, are you suggesting we should do away with this spending?
Well, we can't pay it.
Charles, the U.S. Fed has said that public spending as a proportion of GDP has actually risen in 2014, the labor market equally growing. And, you know, these stats are being reflected in the job openings and labor turnover survey that was posted in December. So if the Fed is saying that the country can afford a rate hike because levels are satisfactory, then perhaps it can afford some of this spending, no?
Well, we're talking short term, we're talking long term. I mean, next day to day, next year, or for the time period that current politicians are in office, we can't keep playing the charade. The charade is that we have enough money to meet all our obligations.
So the easy cash days we sit in today, Charles, tell me, what is that going to do to the American standard of living in even a decade from now if we continue on this, what you call, unsustainable path of spending?
Well, government spending. We have governments that are ineffective at providing services, and they are ineffective at growing economies. You know, the U.S. has never had such slow growth. The most recent data shows less new businesses starting than existing businesses shutting down. That's never happened before. The myth is that the U.S. economy, because it's the U.S. and God is on our side, we are going to grow rapidly enough to pay our bills. The truth is we have put so many restrictions on growth, it's so hard to start a new business. Less new businesses are getting started. There's not the growth that anybody expects. Starting last summer, I said the Fed will not be able to raise interest rates in 2015. The global economy is entering into a recession based upon all the easy money printed by central banks. And I still say that.
The Fed, look at what Yellen is saying. She's pretty much arguing that the situation cannot change in terms of an interest rate hike because of the situation in emerging markets. So as you talk about mindfulness of the global marketplace today, perhaps what she's saying is that the U.S. more than ever before is being dictated by the headwinds in China.
Well, yes, in part. First thing you have to consider that anything the central bankers say, you have to take with a modest grain of salt, since they've never been right in the last 5 years.
But do central bankers in any country really have, what can they really do other than move rates? I mean, they're essentially victims of the marketplace themselves, no?
Unless they say that the governments that we are central bankers for have anti-growth policies in place that make it very difficult to start something new or for an existing business to grow. And without those impediments, or with those impediments, whatever the central bankers can only raise asset prices. The bubble, the inflationary bubble caused by all this free money, is terrifically high asset prices. Both stocks and bonds are valued at enormous prices only as a result of all the money created by central banks.
How much worse do you think this debt accrual situation is really going to be for the investment community?
You have to separate the markets from the central bank, from governments. You know, the one hand, in the stock markets, all there All there is shares of stock and money. Since the end of 2011, the number of shares in the U.S. stock market has been declining. Companies have been reducing the share count, even though individual investors have been taking money out of the market net.
You've got sort of a misalignment of objectives here. We have the state of the economy and what is being presented as an investor community that's being buoyed by the easy cash, right? So at what point do we see the two collide, and what is that going to look like?
It's going to collide when companies start selling more shares than they're buying. And what would that take? It would take a real downturn in the economy.
Okay, so as we talk about sort of this unsustainable growth, Charles, we have to talk about what can be done moving forward. If you're suggesting that we have unsustainable growth, what do you want to see happen?
Well, there's only two ways you ultimately can pay off debt. One is you grow your income, so you can use your income to pay off the debt, or you write off the debt.
Is that really a realistic suggestion, though?
I'll bet you a dinner at any place you want. Within 10 years, something like that will happen. Probably not this year, probably not next year. Look, if you keep spending more than you make and you pay your bills by printing money and that never changes, don't you think at some point people will say, hey, why am I taking this money?